6 consecutive years. Say that slowly. Not 6 consecutive months, not 6 consecutive quarters. 6 consecutive years in which the world has consumed more silver than it has pulled from the ground, refined, and made available for the people and the industries and the governments that needed it. 6 years. And the price of silver as of this morning sits at approximately $67 an ounce. That number and that streak of years do not belong in the same sentence, not if you understand what supply deficits do to commodities over time, not if you understand the arithmetic of a market where demand is structurally, industrially, inelastically growing, while supply is geologically, mathematically, stubbornly constrained. Not if you have ever watched what happens when those two forces meet without the dampening effect of a paper market that has for decades been absorbing the pressure that the physical market should have been expressing all along. The squeeze that is coming was not hidden. The data was public. The Silver Institute published it annually. The mining companies disclosed it in their quarterly filings. The industrial users understood it in their procurement departments. The analysts who cover this space have been pointing at these numbers with increasing urgency for the better part of 3 years. And yet almost nobody saw it coming. Not in the form it is now taking. Not at the speed it is now moving. Not with the structural implications that are now, quietly and then not so quietly, beginning to surface in the machinery of global silver markets. This is the story of how 6 years of accumulated pressure became the most consequential number in precious metals. And more importantly, this is the story of what that pressure is about to do to the price of silver in the months ahead. Let us begin with the geology because that is where every honest conversation about silver supply must start. Silver is not found the way most people imagine it. It is not primarily mined from pure silver deposits. Approximately 70% of all silver produced annually comes as a byproduct of mining other metals: copper, lead, zinc, gold, which means that the decision to produce silver is not made by silver miners responding to silver demand. It is made by copper miners responding to copper demand, by zinc producers responding to zinc prices, by gold operations optimizing for gold recovery. This matters enormously, because it means that when silver demand rises, the supply response is not automatic. It is not even direct. It is filtered through the economics of entirely different commodity markets, the capital allocation decisions of mining companies whose primary focus is not silver at all, and the geological reality that developing a new mine from discovery to production requires between 7 and 14 years under optimal conditions. You cannot turn on the silver tap because the world needs more silver. The world needed more silver 6 years ago, and the tap has been producing less than the world needed every single year since. The Silver Institute's most recent data projects the 2026 supply deficit at somewhere between 46 and 67 million ounces. That range reflects genuine methodological disagreement among serious analysts, not uncertainty about whether the deficit exists. The deficit exists. The only argument is about its precise magnitude. Now hold that number against the context of what has been withdrawn from the COMEX registered inventory in recent months. In a single week in January of this year, more than 33 million ounces of silver were physically withdrawn for delivery. Roughly a quarter of the entire registered inventory. Gone in 7 days. Think about who does that. Retail investors do not withdraw 33 million ounces of silver from a commodities exchange in a week. That is the behavior of industrial users who have made a decision. A very specific and very consequential decision. That they no longer trust paper promises of future delivery and want the actual metal in their actual possession before the window to acquire it at current prices closes permanently. When that conviction spreads through a market, when the buyers stop accepting IOUs and start demanding silver in hand, the arithmetic of paper silver becomes something that exchange operators and regulators do not have clean solutions for. The paper claims outstanding against COMEX silver have for years represented multiples of the physical metal available for delivery. In normal conditions, that discrepancy is manageable because most paper holders never demand physical delivery. They roll their contracts, they take cash settlement, they behave as the paper market requires them to behave. But what happens when they stop? What happens when the industrial user, the solar panel manufacturer with a production schedule, the semiconductor fabricator with delivery commitments, the electric vehicle company with a supply chain that cannot tolerate substitution, decides that rolling a futures contract is no longer an acceptable substitute for holding physical silver in a bonded warehouse they control? We are beginning to find out, and the answer, so far, is not reassuring if you are the institution on the other side of that trade. Before we go further, If what you are hearing is changing how you see the silver market right now, subscribe, not as a formality, as a decision. Because the events that are unfolding in the silver market are moving faster than the mainstream financial press is covering them honestly. And you will want to be informed before the crowd arrives at the conclusion that the data has been pointing toward for 6 consecutive years. Subscribe now. We continue in 10 seconds. Let us talk about industrial demand, because this is the part of the silver story that even serious precious metals investors frequently underestimate. Silver is not primarily a monetary metal anymore, not by volume, not by the mathematics of where actual silver actually goes when it leaves the mine and enters the economy. Approximately 55% of annual silver demand is now industrial, and within that industrial demand, the fastest growing categories are not the traditional ones, not photography, which has collapsed, not silverware, which has declined. The fastest growing categories are solar energy, electric vehicles, 5G infrastructure, and artificial intelligence hardware. Consider solar alone. A single solar panel requires between 10 and 20 grams of silver, used as a conductive paste in the photovoltaic cells that convert sunlight into electricity. As of 2025, global solar installations required approximately 232 million ounces of silver annually. That number is projected to reach 330 million ounces by 2030 under conservative installation forecasts. Under aggressive green energy transition scenarios, the number approaches 500 million ounces. The entire world mines approximately 820 to 850 million ounces of silver per year. You do not need to be a commodities analyst to understand what happens when a single end-use category consumes an ever larger fraction of total annual supply, while that supply is already insufficient to meet total demand. You need only to understand arithmetic. And solar is not alone. Electric vehicle charging systems, semiconductor manufacturing, advanced weaponry and defense electronics. Each of these represents a category of silver demand that is growing with the kind of policy-backed, capital-intensive momentum that does not reverse on a quarterly earnings call. Governments have committed to solar. Governments have committed to electrification. Governments have committed to domestic semiconductor production. Every one of those commitments is, in the most literal physical sense, a commitment to silver consumption. Now layer onto that the monetary dimension. Because silver is not only an industrial metal, it is also the metal with 6,000 years of monetary history behind it. The metal that served as currency for more human civilizations for more continuous centuries than any other substance on Earth. The metal that was demonetized not because it failed as money, but because the governments of the 20th century found it inconvenient to be constrained by a substance whose supply they could not control. And here is where the squeeze becomes something more than a supply-demand imbalance in a commodities market. Here is where it becomes a monetary event. The global money supply, the total quantity of paper and digital currency claims that exist across the major economies, has expanded at a rate that has no precedent in peacetime monetary history. In the United States alone, M2 money supply has grown from approximately $15 trillion in 2019 to over $21 trillion today. That expansion did not create new silver. It did not open new mines. It did not accelerate geological processes. It created new paper claims chasing a physical reality that grew at a fraction of the rate of the paper. When monetary analysts calculate what silver's price would need to be to bear the same proportional relationship to the money supply that it bore during periods of genuine monetary backing, the numbers they arrive at are not comfortable. They are not numbers that the mainstream financial press covers with the seriousness those numbers deserve. But they are numbers that the mathematics supports. And ignoring mathematics because the conclusion is uncomfortable has never, in the entire history of financial markets, produced a good outcome for the person doing the ignoring. The current gold to silver ratio sits at approximately 62 to 1. That means it takes 62 ounces of silver to buy a single ounce of gold. The historical average of that ratio, across centuries of bimetallic monetary systems, is closer to 15 to 1. The ratio touched 30 to 1 as recently as 2011. It spiked to 125 to 1 during the pandemic chaos of 2020. A level that in retrospect looks less like a rational pricing of relative value and more like the kind of dislocation that precedes dramatic mean reversion. At a 30 to 1 ratio, with gold at $4,200 per ounce, silver would be priced at $140. At a 15 to 1 ratio, silver would be $280. Those are not predictions, they are arithmetic. What they require to become reality is not new data or new fundamentals. The fundamentals already support them. What they require is the market's recognition of what the fundamentals have been saying for 6 consecutive years of supply deficits, accelerating industrial demand, and paper market mechanics that grow more fragile with every quarter that the physical tightness intensifies. Let us reason forward carefully, because the question that matters most is not what the data says about where silver has been. The question is what the pressure now building in the physical market means for where silver is going and how quickly it gets there. There are structural triggers now in place that did not exist 12 months ago. The first is the physical withdrawal behavior we have already discussed. When serious buyers systematically prefer physical delivery over paper settlement, it creates a self-reinforcing dynamic. Each withdrawal tightens registered inventory. Each inventory tightening raises the stakes for the next wave of buyers deciding between paper and physical. At some point, and no analyst can tell you precisely when that point arrives, the math of registered inventory versus outstanding paper claims produces a moment that the exchange cannot manage through margin adjustments or position limits alone. The second trigger is the de-dollarization dynamic playing out among central banks and sovereign wealth funds globally. The dollar's share of global reserve holdings has declined from approximately 73% in 2001 to roughly 59% today. The assets absorbing that shift are not primarily euros or yuan. They are gold. And where gold goes in sovereign reserve accumulation, silver has historically followed with a lag that is measured in months, not years. The third trigger is the mining supply constraint that is structural rather than cyclical. The world's major silver-producing regions, Mexico, Peru, China, Russia, are each facing their own combination of geological depletion, political instability, energy cost escalation, and regulatory complexity. New mine development is not keeping pace with depletion of existing resources. And the 7 to 14-year development timeline means that even if every major mining company announced a major new silver project today, the production from those projects would not reach the market before the supply deficit has had years more to compound. These three triggers are not independent, they reinforce each other. Physical withdrawal tightens the exchange inventory that de-dollarization buyers are competing for in an environment where new mine supply cannot arrive in time to relieve the pressure. The squeeze is not a single event, it is a convergence. And convergences, when they arrive in commodity markets, do not announce themselves politely in advance. What does a thoughtful investor do with this analysis? Not panic. Panic is the enemy of the investor who has the right thesis, but the wrong temperament to hold it through the volatility that precedes the recognition. The first action is position clarity. Audit your silver exposure with honest eyes. How much is physical metal that you personally control? How much is paper exposure through ETFs, futures, or pooled accounts? In normal market conditions, the distinction matters less than the purists insist. In the conditions now building in the physical silver market, the distinction is everything. The metal you hold is yours. The paper claim you hold is only as good as the counterparty standing behind it, in conditions where those counterparties are under precisely the kind of stress that tests their reliability most severely. The second action is accumulation strategy. Dollar cost averaging into physical silver at current prices, with the structural backdrop we have examined in this conversation, is one of the most asymmetric opportunities available to the individual investor who is paying honest attention to the data. Not because the price cannot go lower in the short term, it can. Volatility is a permanent feature of this market, but because the structural floor beneath silver, 6 consecutive years of supply deficits, accelerating industrial demand that governments have committed to sustaining, a gold-to-silver ratio at historically stretched levels, is as solid as any foundation available to the serious long-term investor in this environment. The third action is patience structured as a plan. Write down now, before the move happens, the price levels or ratio levels at which your thesis would be confirmed, the levels at which you would begin reducing exposure, and the levels at which you would recognize that the thesis was wrong and act accordingly. The investor who makes those decisions in advance, from a position of calm analysis rather than in the heat of a rapidly moving market, is the investor who benefits fully from being right without being destroyed by being right at the wrong moment, in the wrong way. The squeeze that nobody saw coming was not invisible. The data was there. The Silver Institute published it. The mining companies disclosed it. The industrial users understood it in their procurement departments. What was missing was not information. What was missing was the willingness to follow the information to its logical conclusion without flinching from what that conclusion required. You are here, which means you are not missing that willingness. The question now is not whether the squeeze is real. 6 consecutive years of data have answered that question with the quiet authority of mathematics. The question is whether your position, your structure, and your preparation are as complete as the opportunity now demands. The data says the squeeze was always coming. The only thing nobody saw was how soon. Now I want to hear from you. In the comments below, tell me this. When did you first start taking the silver supply deficit seriously? Was it the numbers? Was it a specific event? Was it something someone said that made the arithmetic suddenly impossible to dismiss? The answers you leave below are not just conversation. They are the map of how serious investors actually think. And that map is more useful than almost anything else I can offer the people who find this channel when they are trying to understand what is happening to the monetary world they live in. Write it below. And remember, this video is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so that you can make your own decisions with your own money and your own risk tolerance. Nothing here constitutes a recommendation to buy or sell any asset. Do your own research, consult qualified professionals for your individual situation, and never invest more than you are genuinely prepared to hold through the full cycle of its volatility.